Hi, this is Chad. Welcome to the presentation, Saving Like the Wealthiest. We're going to discuss the benefits of purchasing a vehicle with your private vault account. To walk us through this, I've invited a longtime account specialist, Dave Runyan. Dave, thanks for being here.
It's good to be here, Chad. Hello, I'm Dave Runyan, and this is a high-yield savings account that gives you a loan while paying you interest. In the next few minutes, I'm going to show you how to get a loan for a Tesla and earn interest on the loan at the same time. We've got to get through a few details first, so stick with me. This is about to get really interesting. And this works for any car, not just a Tesla. Chad just likes Teslas. Well, a private vault account really is just a prepaid line of credit where you are the banker and the borrower. You can write checks off your account. This is a colleague's client. The account holder made a car purchase. He paid over $30,000 for the vehicle, and he pulled it out of the whole life banking account. It took about a week from the time the policy was issued and the time he actually picked up the car and the policy getting delivered, just 7 calendar days. He borrowed out of his savings account inside the mutual company, and he ended up saving himself over $4,000 in interest payments while he was still earning interest on his savings. He's paying himself instead of a bank and earning higher dividends. And that really is what's known as arbitrage. This is where it starts to get fun. We're going to borrow against the cash value of your account, but we're still going to earn interest on that account through the benefit of arbitrage. A common example of this would be a landlord making a $1,000 mortgage payment and charging $1,500 in rent for the tenants. The amount between one cost and another is what we're interested in here. That's the arbitrage. Buying a car with a bank loan is the same thing as investing in a depreciating asset, and you really can't afford it. The vehicle is, of course, not going to be worth as much in 5 years from now as it is right now, but the debt on it will be larger. The interest on that account that you've paid for the vehicle is actually $34,000 for this instead of the $30,000 purchase price. A private vault account is an account where you're both the borrower and the lender. This is an example of a 44-year-old buying a $50,000 vehicle right now. We're going to transfer $62,500 from our bank savings account or wherever you are warehousing your money to a whole life account. Then we take a policy loan and buy the car. Over time, we pay interest on that loan while earning interest at the same time on a bigger amount at a higher rate. This might look confusing, but if you're just pay attention to see these highlighted numbers, which is the cumulative premium, net cash value, and death benefit, it all makes sense. You get access to this money shortly after opening the account. Unlike if you were to put it into a CD or a mutual fund. CDs sometimes have 6 months or a year until you can get the money out. With this account, you can access around 90% of it right off the bat because you are a member of the mutual company. Much like how a credit union has members, so do mutual insurance companies. This is really a big benefit of leaving savings inside these over CDs where you can't touch it for a while. As time goes on, the account holder will have access to much more than they put in. But starting out, if he put $62,500 in, he can access around $50,000. So the account holder withdraws the $50,000 or the maximum cash value limit and purchases the vehicle. At that point, he would have a loan from his life policy, which has an interest rate between 1% and 4%. At that same time, he's paying back that loan. The account with $62,500 in it might be appreciating at 5 or 6%, with arbitrage might now be earning a few percent interest. Over the first 5 years, the policyholder puts in $137,502, and throughout those 5 years, he has access to up to $129,459, which is almost as much as he put in. If you were to close the savings account down, you would not get as much as you put in. But why would you close the savings account down? Look at what happens in another 5 years to your savings. That is when it starts to get fun. By year 10, you have saved around $205,000, but your account has earned over $15,000 over 7.5% interest, or about 0.7 average for the first 10 years, which is still better than a bank savings account. But over the second decade of the account, when you are 15 to 20 years older and probably need it more, it will be there for you in a big way. This illustration shows an account after 20 years of only saving $333,666, and it's worth $477,317. That's a nice difference. This is done through the power of compounding interest and the beauty of arbitrage when you need to access savings for major or consistent monthly purchases. And as an extra bonus, the whole time there is a death benefit. So if the account owner gets hit by a bus or their family or heirs get over $1 million. At age 65, $1 million term life insurance costs more than $1,250 a month. And that is why term insurance is bad over time, because you don't get a refund if you live. And this gets more expensive every day you get older. The borrower saves $1,250 a month after transferring the original $62,500 and took out the $50,000. At that point, the $62,500 starts a lifelong cash flow that a dividend starts working off. Then it becomes a high yield savings account. In this case, $15,000 a year or $1,250 a month goes into savings. It's better than putting it into a savings account with a big bank where only potential to earn a small amount of interest. We can grow income tax-free and take it out tax-free. It makes for a private, tax-free retirement account. You can do this with a car and with some of your bigger monthly household purchases like your mortgage. In this example, we transferred $30,000 in to start the account. $30,000 out of savings account at the big bank, earning basically zero interest. Once the account is open, you can start paying monthly mortgages and car loans. In this example, repeating the cycle of continually saving $5,000 a month inside the account, borrowing out of it for expenses, and paying policy loans back allows compounding interest and arbitrage to work. After 30 years, when the account holder is 75 years old, you've saved almost $1.8 million, but have a net cash value of over $3 million to draw off of. And that is with a $4.6 million death benefit to your family and heirs if you unfortunately pass on at that age. So why would you waste money on term life insurance when you can just pay all of it together on this? There's really no early withdrawal penalties. Loans are from dividends and premiums are tax exempt because at the end of the day, this is a life insurance policy. 401k loans do not receive the arbitrage dividends, and deferring the taxes makes the government your business partner, meaning they get part of the earnings in the form of taxes. Where and how you save your money now at this present time affects your future very directly. If you're a business owner, you should have at least 3 or 4 of these, and they are great for employees' retirement accounts. Ray Kroc ran McDonald's real estate holdings through these. Walt Disney ran the cash flow from the happiest place on earth through a life policy. J.C. Penney ran portions of his business expenses out of life policies. They can be set to fit almost any individual household need, and they give you the ability to finance your expenses through them. Family expenses, property taxes, instead of paying impounds each month, perhaps you pay it through your life insurance policy. Why give the government a free loan, right? We already discussed how you can buy a vehicle through this, and you definitely can finance your vacations through this too. It's just a big lifelong piggy bank. That's the reason I love the private vault account, because it is the most versatile of all the things that we do. It is the most versatile way to put your money to use in several different methods. You can finance vehicles, you can finance real estate, property taxes, start a fund to pay for future college tuition. You can finance your business inventory and procurement needs. You can finance your assets and business equipment. All of these can be done through these whole life banking policies. And that's it. That's the presentation. Saving like the wealthiest. So now that you understand how the private vault works, give us a call and let us know what your short-term and long-term goals look like, and let us show you how the private vault can work for you.